Right now, Hyperscale Data Inc., ticker GPUS, is trading at $0.30305 per share. It is down 8.21% on the day, a loss of about 2.7 cents, and it is scraping the absolute bottom of its 52-week range. In fact, it just hit a new 52-week low of 0.301 moments ago. The volume is enormous, with nearly 30 million shares having traded hands already, which is a significant figure for a stock at this price level. And here is the immediate puzzle. This collapse to a new all-time low is happening just one day after the company issued a press release on November 12th announcing the deployment of over 4,000 new Bitmain Bitcoin miners. This was supposed to be good news, an expansion, a signal of growth. Just 2 days ago, they announced their Bitcoin treasury had swelled to over $75 million. The expectation, fueled by this steady stream of corporate updates, is that Hyperscale Data is building a significant operation, an AI data center business that is anchored by a rapidly growing Bitcoin portfolio. The company itself, just last week on November 6th, put out a release claiming its estimated net assets were $0.47 per share. So the story being told is one of a company trading for 30 cents when its assets are supposedly worth 47 cents. It's presented as a deep value play. But the reality, the one being written by the market in real time, is that this stock is in free fall. The market is not buying the narrative, not at all. A 95% collapse from its 52-week high of $9.98 is not a healthy correction. It's a signal of profound distress. This isn't a stock you're seeing recommended in Schwab Intelligent Portfolios or as a core holding in a Fidelity Wealth Management account. This is the kind of high-stakes, speculative name that traders watch on their Robinhood app or SoFi Invest platform, wondering if the floor is zero or if a 10x bounce is possible. The expectation is undervalued asset, but the reality being priced in by the market is potential insolvency. The heavy volume today doesn't look like smart investment professionals accumulating shares. It looks like capitulation. It looks like investors who held on all the way down are finally giving up and selling at any price, while day traders on Interactive Brokers try to scalp pennies off the volatility. This is a massive disconnect, and the balance sheet tells us exactly why the market is so terrified. When you look past the headlines about Bitcoin treasuries and new miner deployments, the financial health of this company is alarming. The core tension is that while the company is aggressively spending capital to buy Bitcoin, its underlying financial structure appears incredibly weak. Recent filings show a debt-to-equity ratio of over 1,380%. Let me put that in perspective. For every $1 of shareholder equity, the company's actual net worth, it has over $13.80 in debt. This is an astronomical level of leverage. Total liabilities are sitting north of $200 million, while total equity is under $8 million. This is a company drowning in debt. Furthermore, its earnings per share are deeply negative, in the realm of negative $30 per share. It's losing a staggering amount of cash relative to its size. So the reality of the situation is this. Hyperscale Data is funding its Bitcoin accumulation strategy while its core operations are not profitable and its debt is massive. The market sees this expansion not as growth, but as a gamble. It's borrowing to buy a volatile asset, and investors are betting that the debt will come due before the gamble pays off. This isn't like buying Nvidia stock because you believe in its data center dominance, or Apple stock for its ecosystem. This is a binary bet on the price of Bitcoin bailing out a company with a broken balance sheet. This recent price action is the culmination of this fear. The stock has been sliding for a year, but the acceleration downward, despite the positive-sounding news, suggests the market is now focused on the liabilities, not the assets. That $0.47 per share in net assets the company touted, the market is signaling that it doesn't believe that number is real or that it matters. Those assets are likely comprised of Bitcoin, volatile, and mining equipment, which depreciates, and data center hardware, all weighed against very real, very fixed, and very large debts. This is why you won't see this in Fidelity ETFs or Fidelity mutual funds. This is the opposite of the stable, long-term online investing strategy that most people seek. It's a purely speculative instrument. Many traders on the Fidelity trading platform or using interactive brokers trading tools might be looking at this as a short-selling opportunity, betting that the price will continue to fall as the debt burden becomes more obvious. The stock's failure to hold any support level on its way down from almost $10 to 30 cents is a testament to the overwhelming selling pressure. So what does Hyperscale Data Inc. actually do? On paper, it's an AI data center company. This is a hot sector meant to evoke images of cloud computing and high-performance services, much like the infrastructure that powers giants like Tesla stock and its autonomous driving ambitions. However, the company's own press releases have pivoted hard to focus on its identity as a Bitcoin holder and miner through its subsidiary Sentinum. The strategy appears to be twofold. One, build data centers, and two, use capital to buy Bitcoin and Bitcoin miners to operate within those centers, with the stated goal of accumulating a Bitcoin treasury equal to 100% of its market capitalization. This makes it less of a data center company and more of a leveraged Bitcoin proxy. Investors aren't really buying exposure to AI services. They are buying exposure to a company that is itself making a massive debt-fueled bet on the future price of Bitcoin. This is a critical distinction. People looking for investment help or a reliable place for self-investing are usually advised to avoid companies where the core business model is this speculative. It's a far cry from setting up an individual brokerage account with Fidelity to buy a broad market index. The past performance here is a clear warning. The stock chart is a picture of value destruction. An investment of $10,000 near the 52-week high would be worth about $300 today. This isn't a dip. This is a catastrophic loss. The older reports and financial statements from the past several quarters all paint the same picture. Growing revenues, but even faster growing losses and ballooning debt. The company has been raising capital, which often means diluting existing shareholders, selling new shares at low prices, which makes everyone else's shares worth less. This is how it's likely funding its operations and its Bitcoin purchases, by selling new stock or taking on more debt. This is a classic penny stock trajectory, and it requires extreme caution from anyone looking to invest online. Platforms like Robinhood stock trading make it easy to buy fractional shares, and the low price of 30 cents might be tempting, but the risk of a reverse split or even delisting is very real when a stock trades this low for this long, especially on the NYSE American Exchange. Looking ahead, the future of GPUS is entirely dependent on two things. First, the price of Bitcoin. If Bitcoin goes on an absolutely historic run and doubles or triples in a short period, the value of the company's treasury could theoretically expand enough to cover its debts and justify a higher valuation. This is the bull case. It's a lottery ticket. The company's management is essentially all in on this outcome. They are using the company as a vehicle for a leveraged crypto bet. The second, more likely scenario is that Bitcoin trades sideways or rises too slowly. In this case, the clock is ticking. The interest on that $109 million in debt needs to be paid. The massive operating losses need to be funded. This will likely force the company to issue more shares, diluting the stock price further and further, or take on even more toxic debt. The recent deployment of new miners is an attempt to accelerate their Bitcoin generation, but it's a race against time. The market, by pushing the stock to 30 cents, is betting they will lose that race. This is the kind of setup that active traders on the SoFi trading platform or Interactive Brokers platform watch closely, because the volatility can be immense. But it's not a place for a retirement investment. It's not something you put in your Fidelity IRAs. I want you to comment below with your thoughts on this. Do you think this Bitcoin treasury strategy is a smart, aggressive move